Who here, when they woke up on Monday, was concerned about the stock market? We all know we got a lot going on. We got the presidential election about to happen. What came out was poor unemployment numbers, which wasn't great for the economy. There was a market meltdown in Japan. So Monday morning, there was a lot going on. And potentially a war between Israel and Iran. So ton going on, a lot of instability. And so here, I'm just gonna share with you my market turbulence mindset. Whenever there's gonna be economic turbulence, it's good for us. I call this return on attention. I go to jiu-jitsu on Monday, and one of my good buddies there is like freaking out. And then we would roll, he'd get a 2-minute break and he'd be checking his phone. Then there'd be another 5-minute round and he'd be checking his phone. I'm like, bro, what are you doing? He's like, I don't know if I should sell my crypto or not. I'm not sure what I should do. It keeps dropping. And I'm like for me personally, I would never invest on something that would interrupt a jiu-jitsu roll because it's such a low return on attention. Now, I'm not recommending anything to anybody who invests in crypto. You just got to recognize you're investing in an asset class where you potentially have a risk for your return on attention. With real estate, it's exceptionally boring, like Leon just talked about. So, and then there's generally not linked. Generally, when there's market turbulence, it's good for real estate investors. And I've been saying this for 2 years now. To go to crazy rates like we were in 2020, 2021, it means only bad things are happening. So maybe something explodes with the election. Maybe unemployment rates explode. Maybe Japan melts again. For my money, this is probably the most instability raising thing right here, but maybe wars erupt. And then we'll have very low interest rates. And I've been saying this for 2 years. It's like low interest rate environments means there's something very wrong in the world. For example, where was the best interest rates in the last 20 years? 9/11, global market meltdown of 2008, and COVID. Personally, I don't want to go through any of those again. But if I do, I got like 60 or 70 rentals I can refi. And so the great thing about being a real estate investor is that there's always a lever to pull. If you have all your money in the market, you're coupled to whatever's going on in the market that time. So it's like mentally and emotionally, I can't be a great stock market investor because I don't want to be tied to everything. I wouldn't call it a roller coaster. I think the stock market's a great thing. It's just not for me. But I don't want to be tied to if the SPX is going down, everything else is going down. And that is the great thing about real estate. It doesn't move that fast, and that doesn't happen. But the other great thing is when there is instability in the stock market, the Fed is going to juice the economy, which is great for us and benefits us. And so what we've been playing the last 2 years in the higher interest rate environments, because there's always a lever to pull, is flip keys and Brrrkeys. People have been crushing it. Some people have taken the view that I'm going to marry a house and date the rate. And so our turnkey market has still been strong too. It's just everybody's making their choices for what's best as them and as investor. But I just want to remind everybody that real estate is anti-fragile to the stock market. That when the stock market's going nuts, real estate generally gets stronger. And so when I heard people on Monday and I saw the pundits on Monday talking about the massive market drop, I'm like, cool. Maybe I should look at rates again because I haven't looked at them for a long time. Rates did drop 0.5 point on Monday. They clipped up. My personal opinion, and I can show you guys the numbers, is you do not get wealthy in low interest rates environments. Prices go up, then you start getting nervous if you're overpaying. You get wealthy when through a systematic acquisition strategy, you pile up a bunch of assets, and then when rates do drop and there is turbulence in the market, you refi everything out. What do I mean by that? My friend Frank Cava, he's an investor in Richmond, Virginia. He had a $4 million portfolio that in 2020, he refied all of it to a 2.5% interest rate. So he created, with one move, with one massive refi, he created generational wealth for him and his family. So disclaimer, I'm not making predictions about the election, the war in the Middle East, jobs reports, or interest rates. I'm just saying interest rates might be coming. I think there's a high probability rates will be coming down. I thought they'd come down earlier this year. I think we're going to be about 90 days late. But if you haven't been necessarily considering turnkeys because of the interest rate, it might be a decent time because especially with our rate buy down, we're getting people rates in the 4s. The basic concept to understand is that if there is a note on a property that you are Brrrkeying and you want to refinance that house out, the bank will refi you out 80% of your total cost, rehab plus purchase price, the day you say it's appraisal ready, whenever the rehab's done. This is what I learned this week. I've been recommending people wait for the appraisal until the tenant's in there. But Michael is saying you can take the appraisal as soon as the rehab's done. I will get his thoughts on whether it helps if there's a tenant stuff in there, if it looks like it's better appraisal worthy or not. But he's saying, no, people are doing it as soon as the rehab is done. The thing to remember, there's a note on the property. It'll be called a rate and term refi and 80%, which is nice because I also only thought they were refining out 75%. Now here is, for those of you who are planning to use your own cash, if there is no note on the property, the bank will only refi out 75% of your purchase price and closing costs. That's a big deal. If you're buying a $200,000 house and your purchase price is like $130 and your rehab is another $30 and you're all in for $160, if the bank only refis out 75% of your purchase price, which is $135, you still get the house on a 20% discount, but you're not able to maximize all your cash. You're going to leave more cash than you need to in that deal. So that's the dilemma to overcome. What I love about Brrrkey is you guys all come here with a big pile of cash, and then problem with turnkeys is like, boom, that's a big chunk of cash I'm never getting back, getting a great asset, but not getting it back. I can keep this big pile of cash living as long as possible. If you're all into the house at 80% of its value, you're good. Now at turnkey, you put your down payment in and that's gone forever until you do a cash out refi when the house appreciates. So like worst case scenario, you still get a great deal, still get a great house, still get it undervalued. But I like to maximize all levers in real estate. So this is just a strategy. Make sure you're able to lever everything.